I've been not damned, by Premier Dan Andrews mistakenly going to Melbourne last week, so I'm locked up until midnight tonight. Well, I hope it's midnight tonight, but what do we learn about reporting season? Can BHP keep paying bumper dividends and US bond yields on the rise? What local stocks will be affected? I'm mad at Dan, but I'm also mad about money, and joining me is my fellow money madman, Paul Ricard. Okay, off goes the mask, blow Dan Andrews, and let's get down to being mad about money, Paul. What have we learnt from reporting season?
Well, reporting season's kicked off pretty well, Peter. I think most companies are beating. That's a good positive. But two things stand out. One, consumer-facing companies are doing well. They're the big retailers, companies like JB Hi-Fi. We saw it with some other ones last week. Anyone which is involved in basically providing services and things to consumers that they can buy when they can't travel overseas are doing really well. Coles this morning, perhaps not as good as I might have expected, but I think we'll see some good report tomorrow from Wesfarmers and Woolworths later in the season. The other thing, Peter, are dividends. They're way up, right? Not just the big resource companies. CBA was on the upside, was on the high side. We've seen a number of companies basically pay higher dividends than expected.
Yeah, and that's come from the stronger economic rebound, and that's exactly what we've been saying about mad about money for the last 9 months, where we were on the money. We're not just mad about money, but we're on the money. Let's go to the next one, Paul. We didn't get the bell, but we'll go anyway. There it goes. BHP, this bumper dividend, can they keep on keeping on? Yeah,
very positive report from BHP yesterday, Peter. 101 US cents for the interim dividend. That's about 128 Aussie cents. Look, it can, Peter, because they had a payout ratio of 85%. We spoke to the CFO after the result. I got a lot of confidence out of that in the sense that they basically asked him the question about what would happen in the second half. Could they keep it up? He basically sort of said yes, that sort of payout ratio could be maintained because their capital plans are locked in and they've got nothing else to do but to send the money back to shareholders. The interesting point about the BHP report as well yesterday, Peter, was that their realised price, or the average realised price for iron ore in the first half was only $103 US. Now we know the spot price is trading about $150, and that reflects partly the delay in terms of getting the thing sold versus the spot price, but also just the time delay from as the price has been going up. So they come into the second half a lot better starting pace than they did in the first half. And also the copper price has gone up. So the second half at the moment, I know we're only 6 or 7 weeks in, that's also set to be a bumper. So expect to see another bumper dividend in the second half. And I think given what's happening with Vale, and we know what's going on with growth at the moment globally, we're seeing commodity prices, they're shooting higher. I think we can probably expect to see good BHP dividends for some time to go.
And Paul, that puts a floor under the share price, doesn't it? Because there'll be people who might not even hold BHP, but see the dividends being an attractive thing, so they'll buy it.
Yeah, they will. And this is obviously the part of the problem for BHP is because about 70% of the earnings are now coming out of iron ore, Peter, and 25% or 20% from copper. There's not much else. They really need to get their handle out in some of the exploration and on this potentially growth options. So that's going to be a longer term problem. But for the next couple of years, very disciplined company. I think dividends are going to be pretty good and shareholders are going to get lots of cash back.
All right, let's go to the next one. The Belgians just gone missing in action.
Yeah, well, you can't always get, well, let's move on, Peter. I want to be insulting to our team member.
Good help side the fine. Anyway, next one. The bond yields in the US are rising. Now, remember, when bond yields were falling, it was like a prelude to a recession. So is the bond market basically saying, yep, the world economy is looking good down the track?
Well, I think that's what it is. Yeah.
And what will it do like with shares?
Yeah, and that's what it is sort of saying, Peter. I mean, the bond market is looking a long, long way ahead, right? And I think we've been warning for some time about a steepening of the yield curve, both in the US and in Australia. And that's what's starting to happen here because what investors are doing, they're looking ahead and saying, okay, we can see commodity prices going up. We can see the oil price going up. We can see growth picking up at some stage. That's going to relate to build up inflationary expectations. The other thing that's going on is that the US government and the Australian government are pumping up so much money into the economy that in itself has got to be paid through by more bonds. it also means at some stage the central banks have got to unwind their positions that they're accumulating as they buy on the other side. So it's sort of like a, why do you want to buy a long bond when we know that, over the long term, all the debt that's been issued, someone's got to pay for it. And secondly, there's a good chance of inflation picking up. So that's why the curve is sort of steepening. I've been aware, as I said, Peter, warning about this for some time, and I think that's what we're starting to see. And what that means for our market in particular is some of the so-called bond proxy stocks, the Transurbans and the Sydney airports and other stocks, they're going to come under pressure, not because they haven't hedged their interest rate costs, but just our market tends to, whenever it sees bond rates go up, it tends to sort of say, okay, bond proxy stocks, you cop it, and we'll see some downward pressure on those share prices.
They're saying people who might have bought them for dividends may well lose out because of the bond funds that go along these US and Australian bonds are going to be doing better.
Yeah, look, that's part of it, but I think it's more so that they're just seen as surrogates for bonds. And so in some ways, if bond yields and go up, then so does effectively the return you need to get out of your Transurbans and your Sydney airports. They also have a lot of debt. Now, although that debt is all hedged and all locked up, at some stage they've got to replace it. And when they replace it, they'll be paying a higher interest cost. And therefore they'll have less money to return back to their unit holders. Now, I'm not saying the market's totally logical about this. Markets are not logical. Markets are irrational. But what we do is we pick up on US trends. So when bond yields go up in the US, Australian bond market follows suit, and we see selling pressure on the so-called bond proxy stocks in Australia. I still think there's more to come here, Peter. I don't think we're out of this steepening yield curve trade yet.
Okay, really good warning for those people interested in those stocks. Well, I'm Peter Switzer.
And I'm Paul Rickard.
And we're mad about money. And I'm mad about Dan Andrews to make this whole show a lot harder than it's supposed to be.